The U.S. economy, at first glance, looks incredibly strong. Growth remains steady. Unemployment is low. Consumer spending continues to surprise on the upside, and the stock market has been pushing toward record highs. On the surface, everything seems to signal resilience and stability. But beneath that strength, there's a growing concern that many investors are starting to quietly pay attention to. A risk that isn't obvious in the headlines, but could have major consequences if it unfolds. To understand this, we need to look beyond the top-level numbers. Yes, GDP growth has held up better than expected. Yes, companies are still reporting solid earnings. And yes, consumers are still spending. But the key question is, what is actually driving this strength? Because not all economic growth is created equal. Sometimes, strong data can mask underlying fragility. One of the biggest drivers of the current economic strength is consumer spending. The American consumer has remained surprisingly resilient, even in the face of higher interest rates and persistent inflation. People are still traveling, shopping, and dining out. But here's the issue. A growing portion of that spending is being fueled by credit, not income. Credit card balances have reached record highs, and delinquency rates are starting to tick up. In simple terms, people are spending money they don't necessarily have, and that's not sustainable long-term. At the same time, the impact of higher interest rates is still working its way through the system. The Federal Reserve raised rates aggressively to combat inflation, and while inflation has cooled somewhat, those higher rates are now putting pressure on both consumers and businesses. Borrowing costs are significantly higher than they were just a few years ago. This affects everything from mortgages to car loans to business investments. And while the economy hasn't cracked yet, the full effect of these higher rates often takes time to show up. Another hidden risk lies in the labor market. Unemployment remains low, which is typically a sign of a healthy economy. But when you look closer, there are signs of softening. Job growth is slowing, temporary employment is declining, and some industries are quietly cutting back. Companies may not be announcing massive layoffs, but they are becoming more cautious. Hiring freezes, reduced hours, and slower wage growth are all early indicators that the labor market may not be as strong as it appears. Corporate health is another area that deserves attention. Many companies have managed to maintain strong profits, but a lot of that has come from cost cutting rather than true growth. Margins are being protected by reducing expenses, not necessarily by increasing revenue. At the same time, corporate debt levels remain high, and refinancing that debt at higher interest rates is becoming more expensive. This could put pressure on earnings in the coming quarters, especially for highly leveraged companies.